The Lyft IPO. Who is excited? Are you excited? Me? Am I excited? No, I don't care. But this IPO could mark the end of the bull market, so we should all kind of care, at least a little bit. And I mean, I don't hate Lyft. I actually like Lyft. They've been giving me 25% off rides for like the llast 2 months. Every few days, they're like, hey, you're a good customer. Here, take 25% off. Up to $6, which is annoying because it's like the bottomless mimosa up to 5 mimosas. Like, well, that's not bottomless. That is clearly a bottom. But that's what I love about these private companies when they just throw money at customer acquisition. They're basically paying me to ride their ride, which I do over Uber because I'm getting that 25% off. And that's just part of why these companies going public could be bad for the market. And to help explain what's going on, we got Jawad Mian, a very smart macro consultant, has that Stray Reflections blog. And actually this is his Twitter, which I'll link to in the description of this video. Super smart dude though. So he posted a tweet storm that started with some thoughts on Silicon Valley's endgame. We have long said the biggest risk to the bull market is an Uber IPO. That is now upon us. Now Lyft, Uber, they're pretty much IPOing at the same time. And depending on when this video comes out, Lyft might have already IPO'd. And Lyft is just one of the high profile tech IPOs that are coming out this year. Like Jawad is talking about, we got Uber, then we got Slack, Postmates, Pinterest, Palantir, Peloton, Airbnb, all these companies that have gotten really big in the private markets, like bigger than we ever thought possible before. And they're getting so big, like unicorns, right? So a unicorn is $1 billion valuation for a private company. Well, they're getting so big that it became sort of a bubble, which is what Jawad is going to talk about. And part of the reason they've stayed private for so long is because the money has been so easy. With the low interest rate environment, people didn't know where to put their money because there wasn't very many good investments. So it was pumped into the private markets. That's why we got like 5 freaking scooter companies. As soon as you slap scooter on something, someone's going to give you $1 billion. But the fact that these guys are IPOing might mean that the money's drying up in the private markets. But I'll let Jawad explain it. He's much smarter. In 2015, venture capitalist Bill Gurley, with a U not an I, predicted dead unicorns and that all these private valuations are fake. He's since changed his tune because he says you got to play the game that's on the field. So Bill is a smart guy. I mean, even though he was saying that all these valuations are way out of control, he's like, that's the game, you gotta play it. It's a good indicator that he's fallible. So the value of the Nasdaq grew from around 1,000 points in 1995 to more than 5,000 points in the year 2000 at the bubble peak. And that basically mirrors the extreme jump in US unicorn valuations from 100 billion to about 500 billion in the past 5 years. Bubbles pretty much all play out the same way. So just like the Nasdaq quintupled, the valuations of these unicorns quintupled too. And if you look at that Bitcoin bubble that we saw recently, well, you probably see the same thing. China is now home to 168 unicorns. Jeez. We're at the total of 628 billion. It now just takes 4 years, that's it, in China for a new company to achieve unicorn status compared to 7 years in the US. In fact, nearly half of the Chinese unicorns became so just 2 years after launch. Jesus. Now, if you watched the China series that we put together a while ago, you know how bad it is in China as far as debt spending and just crazy stuff with the Gerschenkron model. And if you haven't seen those videos, I'll link to them above. But why wouldn't you expect the same thing to be happening in their private space with their unicorns? Of course they're going to be inflated and even worse than over here. Because China, they're all about those steroids, that stimulus. So the median global VC deal size for late stage companies was around 11 million in 2017. But now mega rounds of 100 million plus are more common. And he's talking about rounds of funding. So a late stage company, before they're public, they would raise 11 million in a late round when they're pretty much off the ground in a successful company. But now they're raising over 100 million in those same rounds. And geez, that was just in 2017 to now. That's crazy. So like I said, these companies are raising way more money in the private markets than they used to. Lyft, Uber, all these guys. And they're raising so much that the CB Insights is actually considering lifting its threshold of a mega round to 200 million or more because the 100 million has become so common. VCs are raising ever larger funds at an increasing pace despite the lack of viable opportunities. Sequoia raised 8 billion, the largest ever by a US venture firm. It's easier to raise money than any time I've been in business. That's what I was saying, all this easy money. Jawad says this does not bode well for future returns. And when you have all this money in the market, like it runs out of actual good opportunities. So it just goes to whatever the hot buzzword is. So that's why we got, 5 scooter companies. Even when the economics of that business is terrible, those scooters get beat up and need to be replaced, and they're barely even covering that cost. But we still got 5 of them. I don't know if it's 5. I mean, I just see a lot of those damn companies with their scooters everywhere. As Jawad said, discipline is loosening considerably. Brad Feld noted that a number of companies, oftentimes with nothing more than a team and a PowerPoint presentation, have had great success raising capital north of that 10 million level. He views that as as a significant negative indicator. Bird, the scooter company, is the fastest company to unicorn valuation, raising 4 rounds in less than 12 months. Wow. In less than 6 months, DoorDash's valuation nearly tripled to $4 billion. Robinhood went to $5.6 billion from $1.3 billion. Coinbase to $8 billion from $1.6 billion. They're just getting valued higher and higher, faster and faster. It's not this type of growth. It's not standard growth. It's exponential growth. And that's what you see in bubbles, right? And when I say growth, it's growth of valuations, not actually the growth of the company. Valuations are growing way faster than the company can grow, obviously. It's hype. It's that sentiment. That's what says valuations, not intrinsic value. And that's why I don't even like the word value, because it's so subjective. Value is always subjective. If you're trying to value what a company will be worth 10 years down the road for something like scooters, like technology is moving so fast that you can't actually value that. So whether you value it at 50 billion or 70 billion, I mean, what's really the difference? It's so abstract, right? And that's why when the bubble finally bursts and the sentiment turns, it's like a huge air pocket, just an empty gap. The valuation will fall just like that. 70 billion? Oh, what's the difference between 70 billion and 10 billion? We're just speculating, really. Even more of the traditional funds are getting into it, like mutual funds. There's been a 10-fold increase in VC stage investment by them in just 3 years. And now more than 250 funds hold positions in private tech companies. The SEC chairman is trying to make it easier for mom and pop investors to invest in private companies too. Oh, geez. You know, there's some rules about who can invest in private companies. Normally you have to be an accredited investor. Like for an accredited investor, you got to have a net worth of at least $1 million excluding your house. Or I think you got to make at least 200,000 in the last 2 years as income per year. So not just anyone is allowed to invest in anything. And that serves as protection against people who don't know what they're doing because they could get scammed. Even though it feels like a lot of these accredited investors are getting scammed too in these VC firms. But it's like the first guy said, you got to play the game that's being played. Banks said that in 2008 too. Loans for everybody. So a Stanford professor examined 135 unicorns and found that nearly half would lose their unicorn status, which is their $1 billion valuation, after taking into account the complicated structure of multiple funding rounds and generous promises to their preferred shareholders. But because of QE, as I said before, capital was abundant, but it had nowhere to go and be productive because the world was still in a downturn. So the scarce asset was growth, and that's why a bubble has been created in the riskiest long duration asset, which are venture-backed companies. So trying to bet on an Uber, like that's very risky. Betting on startups in general, extremely risky. And it's a long duration. Like these things take like 10 years for them to go public and for you to get a return on your investment. I mean, there's other ways too, but the point is you're waiting a lot longer in these private companies than you would in something like the stock market, depending on your strategy. Technology was a bubble of last resort. Soaring tech valuations are really more a commentary on the plummeting value of capital than the value of the tech companies themselves. Explaining again, if there is nowhere to put the money, they're going to put it here. But this is now changing as money is becoming scarcer and the cost of capital is rising. We're in a rising rate environment now, right? Well, Fed backed off a bit, but the general trend is up. Liquidity getting drained. So Uber burnt 20 billion since its founding a decade ago, and now they're accessing public markets as the private capital is finally tapped out. A century ago, this similar thing happened with railroads. The guys building them needed to fund their massive expansion plans, which was based on an extreme overestimation of the market opportunity. On seeing the announcement of a new issue of stock by the Northern Pacific and Great Northern Roads, Jesse Livermore, the legend, he said, "The time to sell is right now." If money was already that scarce and the railroads needed it desperately. What was the answer? Sell them, of course. So to sum it up, when the leading company in the hottest sector goes public, it reflects a peak in social mood and usually presents an important inflection point in financial markets. As a rule, the insiders sell at the top. If they're going public now, that's a signal for all of us about what's really going on behind the scenes. If the insiders are cashing out, we should take notice. The party might be over. The AOL Time Warner merger in 2000 culminated in the tech crash. The Blackstone IPO in 2007 presaged the 2008 meltdown, and the Glencore listing in 2011 marked the peak in the commodity supercycle. Uber, we believe, will mark the peak in Silicon Valley and tech valuations. Let's not forget the consequences of humans' compulsive greed and hubris. Uber and many other Silicon Valley unicorns could be worth multiples of their current value over the long run, but not without first facing a reality check from public markets. The time to worry is now. So what Jawad is saying is that now, as these private companies become public, all these unicorns, this is when they're going to face that first huge correction. He believes a lot of these companies are valuable in the long term, but the valuations right now are just insane. Even Amazon got cut down multiple times, right? But the issue right now is that tech is kind of leading this market. So with these new tech giants finally becoming public, you're going to get real valuations. Hopefully. But Jawad is betting that they're going to be more real than what they had in the private markets. And that could really do some damage to the stock market and maybe trigger something which could wake the bear and end the bull. This is great analysis. I mean, we've been tracking this sort of thing for a while now. Everybody has. What's going to happen when these guys finally go public? The jig might be up. The people in the water might be not wearing the pants because the tide is pulling and the pants come off. And we're going to have a no pants party, which is usually fun, but not in this case. Let's keep an eye out and see what happens. But if we're investing in the market, be careful with with this Lyft IPO, this Uber IPO, if you're feeling those emotions forcing you into those stocks without a good strategy or without a plan, without understanding, make sure you check out my FOMO trading guide. It helps prevent FOMO, so when all your friends are jumping into Lyft, you can be like, no, I'm not missing out. I have these tips and tricks to help me with that. I'm special. I say that every day as I'm reading this guide. You can go to this page and just throw in your email and I'll send it to you for free. I'll put the link up above or down below in the comments or description. You'll find it. Just don't get emotional. I know we love Lyft, love Uber, but we gotta keep it in our pants. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get an email notification when our next video comes out. If you like this video, you're gonna like all our videos. We publish 7 days a week. 7 days every single day. I missed a few days recently, but no one remembers that. I do. But subscribe, come hang out. We talk about fun stuff. We have fun, we joke, we laugh. Subscribe, and I will see you in the next video. But in the meantime, stay fallible out there. I'll talk to you soon. Bye.